Why you shouldn't pay much mind to high valuations on your stocks. I was reading an article today, this morning, which kind of confirmed my belief, what I use in my own prognosis, if you will, about market returns. How the stock market, the returns are based on earnings growth. I mean, that's all there is to it. You know, we get lots of ideas on the Shiller-Cape ratio, cyclically adjusted price-earnings ratio. Lots of stuff that says when the PEs are high, the future returns will be low. All that stuff. And I think the Shiller-Cape stuff we can kind of put that behind us now because it just hasn't worked out the way it was intended over the last time. We're talking going back to 2008 now, I guess. You know, so we got almost 15 years of the Shiller-Cape ratio not doing what it was projected to do. And so literally 15 years, man. That's not quite a retirement, but that's about half a retirement lifespan. If you're invested based on that, as you went into retirement, you left a lot of money on the table that you can't afford not to get. Anyway, so the issue, and then again the idea that high PEs will lead to lower returns in the future. A couple of things that I want to talk about in this. One, I was reading this article, and I can't remember the exact year, but a significant amount of time. And the guy did research this, and I can't remember the exact amount of time. If it was 50 years or 100 years, I just can't remember. But it's a number of decades. So of the returns of the S&P 500, 97.5% were attributed to earnings increase. 97.5%. 2.5% were attributed to PE increase. And I just thought, I'd never seen it put like that. I thought that was amazing. And I use a Bogle model, which says future earnings growth year over year plus dividends will give you future earnings. Not in any given year, because any given year the PE ratios are all over the place because human beings are emotional. We're emotional critters, that's for sure. So sometimes you're going to buy stuff up to make the PEs go through the roof, nosebleeds, and other times you're going to be scared to death and you're not going to touch it with a 10-foot pole. But over a course of 5, even 10 years, the PE ratios will mimic that of the earnings growth. And Bogle will say the dividends, which I agreed with. Anyway, so it was interesting. So I can't remember the guy's research, but he has a lot of stuff on there. And he was his research was, his company was more than, it was incredibly interesting. And then I look at another graph, and I forgot what this graph was, from Macro Trends, I think. And I tried to download it. I was actually going to pay for the data because it showed you the going back to like I think this is going back to 1918. It showed you the data of the S&P 500 year over year relative to earnings growth, year over year, S&P 500 performance relative to earnings growth, and it tracks quite phenomenally. It was interesting. I mean, not 100% correlation, but a pretty significant, over 90% correlation. And I just find that interesting because I hear all the time the earnings growth is fueled by, debt spending, or the earnings are too high, price earnings ratios are too high. And I sit there and I say the issue that we have now, what we have to contend with, is back in the old days. I was reading another article about the Fed funds rate averaging like 5.5% for the times from 1970 to 1990 or something like that. I think it was. If you have a Fed funds rate, which is an alternative investment to stocks that are paying 5.25%, that means you need to get a significant market return in order to justify you being in the market relative to the safety of a bond, or in this case, a CD, essentially. And so you're going to have less of a high price earnings ratio because your risk alternative is high. I can't stress this enough. If you think, or if you can, your risk-free asset is paying 5%, all right? Well, you want more, significantly more than 5% to invest in a risk asset like a stock. If the risk-free asset is paying, 2%, you don't need as much as you would if the risk-free asset was paying 5%. And that's why they say don't fight the Fed. When the Fed is raising, your stocks can be problematic because they say the risk asset needs to generate higher returns to justify me investing away from the risk-free asset into the risk asset, if that makes sense. I hope that makes sense. I thought about drawing this on my whiteboard, but there's not really much to draw. And I'm driving to get Maddie down at Georgia Tech right now. So I just want to yap on this a little bit. Anyway, so if I'm getting, just inherently makes sense. Just like the increase in bonds will make the price drops, decrease in bonds make the price go up. It's just basic common sense. If I have the exact same bond, the exact same issuer is paying me $50 a year in a coupon, that will be worth more than the exact same bond, the exact same issuer, the exact same maturity that's paying me $40 a year for a coupon. It's literally that simple, and vice versa. And the same thing happens here with stocks. If my risk-free assets are 5% and I'm expecting 8% on stocks, or my risk-free assets are 2% and I'm expecting 7% on stocks, inherently it makes sense for me to buy up more stocks and thus increase the PE ratio. But the irony of it all is the PE ratio in of itself isn't what determines the price of stocks over time. It's just not. What determines the price of stocks over time is earnings growth. And I just sit there thinking, are we more likely to have higher, lower, or regular earnings growth in the next 10 to 20 years? And automation can't help but increase earnings growth. It just can't. Because you have less employees, and what's the biggest cost of business is labor. So automation cannot help but increase earnings growth. There's just no other way around that. Regulation hurts earnings growth, that's for sure. Well, Trump's doing pretty well in that regard. He's reducing regulation, i.e. allows less compliance officers, less labor to make sure you got all your I's dotted and your T's crossed. So you got automation, we got massive amounts of technology. I don't think we attribute the insanity of technology and what we could do now relative to what we could do 20 years ago. I think we forget, 20 years ago, how much more we've grown, how much more efficient we are, how much more productive we are in the U.S. of A. So everyone says the U.S. workforce is old, stagnant, lazy. It's not true. The productivity of U.S. workers is growing significantly. And one of the reasons is because we have a Superman working is because technology's allowed that. So anyway, we got technology, you got an automation, right? You got less regulation, and I can't help to think that earnings growth are going to continue on a decent trajectory, which will lead to future returns that are better than what I think a lot of people are expecting, myself included. I'm expecting 5 to 5.5% earnings growth year over year with a 2 to 2.5% dividend yield. That's why I get my 7.5% stock returns when I do my right capital software projections. That's nothing to write home about, that's for sure. Now, some people say, well, GDP, because GDP is 2 or 2.5, hopefully 3%, that puts a limit on earnings growth. GDP has nothing to do with earnings growth in a company. I never understood that argument. Does earnings growth equate to GDP? No, GDP is spending. It's government spending plays a huge role. Trade plays. GDP and corporations' earnings growth have nothing in common. I guess you could say, well, if government spending is being reduced, GDP will be reduced, and then corporations will have less government spending. Yeah, maybe, but that just also means there'll be less debt to pay in the future because the government isn't spending as much. So show me the matrix that shows GDP equating to stock price appreciation. I don't know of any. If you can show me one, let me see it. I'd love to read it. That doesn't make any sense to me because GDP averages on 2.5 to 3%. Even during the roaring 50s, GDP was maybe 4, 5, something like that, and stock prices went a whole lot more than that. So anyway, one of the issues I contend with a lot is people worried about debt. I get it. Name one country that doesn't worry about debt. And some people say, well, we're the most attractive redhead stepchild. Okay, but we're still dealing in the world economy as it is, with human beings and countries that we have to contend with, we're competing with, we're trading with. And if we're the prettiest girl of the redhead stepchild crew, that still makes us very attractive for sure. And then people say, well, at some point the government debt is going to explode, and people say that. I'm not disagreeing with that necessarily. I just don't know why that has to happen. I don't know. And I mean, I especially when we own most of our own debt, I don't get that. I literally do not get this idea. And I'll just go back to what Newt Gingrich used to say about the debt, or I think it might have been Reagan too. We can grow our way out of the debt. I don't know that to be true. Frankly, I don't think we'll ever grow our way out of the debt, because if we have such surpluses, there'll be a government that will want to spend those surpluses, not pay down debt. And how do you pay down debt? I literally don't know, and you don't know. I mean, it's never been done. And because we're the prettiest girl of the redhead stepchild crew, people are still going to lend us money. Obviously we can print our way out for sure, but I don't think it's a crisis of foretold crisis that people are making it seem like, oh my goodness, there's no way we're all going to go bankrupt. It's going to be hyperinflation. I don't believe that for 2 seconds flat, because again, what determines stock growth? We haven't ever had hyperinflation in the U.S. We've had inflationary times, the 70s, big inflationary times back in the aughts. I can't remember. I was reading a couple of books I've read on this. I just off the top of my head I forgot. But more depressionary and deflationary times, recessionary times, and massive inflationary times for sure. So anyway, I don't think you should worry about it. I think if stocks are growing because of earnings growth, I don't think you should get out because PE ratios are too high. PE ratios, the thing you have to worry about is interest rates increasing which would compete with stocks. And what's the likelihood of that happening? I mean, who's going to raise interest rates? The Fed's going to raise the federal funds rate to 5%. And what the federal funds rate right now, I think it's 2.25%, right? Something like that. We had a guy just today say he just refinanced his 30-year mortgage, 30-year VA mortgage at 2 3/4 with a cash out. It used to be a cash out gave you a much higher interest rate because of risk, and that you didn't have as much equity left in your home, and you could literally take that money and sniff it up your nose. He got 2 3/4 on a cash out refinance, which is nuts to me. I actually looked up Navy Federal, and they weren't enough for me to refinance, that's for sure. But anyway, that's crazy. So you got this huge insanity of the federal funds rate being 2 to 2.25%, with long-term interest rates being less than 3. 30-year bonds are still 2.2. So interest rates aren't going up. I mean, the short-term rates, yay, but who cares? There's the long stuff that really has to compete with stocks. Everyone who invests in stocks know it is a long-term endeavor. It's not a short-term endeavor, and thus they should know that they're in there for the long haul. I mean, investors, speculators are different, but speculation is silly. And literally what they'd do if Elizabeth Warren ever got in, or Bernie Sanders, he'd make a transaction tax, which I don't agree with necessarily because it's your money. But I think there's something to be said about transaction tax to stop speculation. I don't like that. But I get other people mentioned transaction tax too, as something to stop speculators from day trading and whatnot. And it wouldn't be much, but it'd be enough to warrant people, say, yeah, my computer, my high frequency trading algorithm, I'm not going to use that anymore just because the cost of the Bernie trading tax. I tell you, I think that's inevitable. By the way, there will be a transaction tax at some point. The federal government needs to raise the money for Medicare and Medicaid, never mind Social Security, and they're going to get it. And I think an easy argument to be made is high frequency trading hurts. Or hurts this, mom and pop investor. And I actually think there's some validity to that for sure. I guess I'm showing my left-wing street cred here. I had a couple guys saying, "You've gone left." I'm like, dude. Anyway, so don't worry about PE ratios so much. I mean, if they get to nosebleed seats, that's one thing. Especially if the competing investors are, freaking. I mean, my goodness, if you can get 8% fixed annuity, and we're at 43 PE ratios, that'd be something you want to concern yourself with, but we're not there anywhere near that right now. I just don't think it's an issue to concern yourself with. Earnings growth is still solid. In fact, if anything, earnings growth will be growing. Risk-free assets are not attractive at all, and I would suggest that for homes, real assets, there's still appreciation there, and certainly for stocks, I really do believe that. But Josh, you said there'll come a real estate crash. I said a coming real estate crash on vacation homes and second homes. I do believe that. All these old people going to retirement, they can't. I don't say when they can't afford it. They don't want to carry 2 homes, and so they're going to be flush or plush. Is that the word? Flush, I think, with a lot of supply, and there'll be less and less demand. So you can see easily a vacation home opportunity coming in the next, I'd say, 5 to 10 years. But I still think real estate of itself, buying a home, it has value there for sure. But I still think stocks are the best way to go. I will see you.